All right, let's look at the data. Today, we're digging into a really fascinating situation with Corsair, the PC hardware company. We're seeing this massive divergence between what the market thinks is happening and what the hard data on their profitability is showing us. And look, this isn't some small miscalculation. It's a huge anomaly hiding right there in plain sight.
This really nails the whole issue. There's a core mechanical advantage at play here, and it seems like it's being completely ignored by the mainstream analysis. So in this explainer, we're going to break down exactly what that mechanic is, why the market's missing it, and what it could mean for the stock. Let's get into it.
Okay, so first things first in our investigation, we need to figure out just how big this disconnect really is. How undervalued is Corsair, ticker CRSR? How undervalued is it, really? To do that, let's put it side by side with its direct competitors.
And this is where it gets pretty wild. You've got competitors like Logitech and Turtle Beach trading at PE multiples of 21 and 14. But the market, it's pricing Corsair like it has absolutely no pricing power at all. This kind of gap, this kind of market anomaly, it just screams that we need to take a much deeper look at how the company actually works to figure out what's really going on under the hood. So the key to this entire puzzle is a concept that's pretty critical, but honestly gets overlooked all the time. It's called structural inventory lag. And this is the hidden engine that we believe could totally drive a significant reevaluation of the company. So what is it? Simply put, structural inventory lag is just the time it takes to turn raw parts into a final product you can sell. For most companies, yeah, it's just a standard part of doing business. But for Corsair, right now, in this incredibly volatile market, that lag has turned into a really powerful and totally hidden source of profit. Here's exactly how it works for them. Corsair runs on a 90 to 100-day inventory cycle. So the memory modules they're selling right now for the holiday season, they were actually built with DRAM chips they bought way back in July and August. And back then, spot prices were way, way lower. It's the classic case of buy low, sell high, baked right into their operations.
And this just shows you the sheer scale of the opportunity we're talking about. Since Corsair bought the parts for the products it's selling today, the market price for those exact same parts has almost doubled. This is the fuel right here for a potential margin explosion that the market seems to be completely blind to. It's a massive tailwind for their profitability.
Now, this whole inventory thing, it seems pretty clear, right? A direct driver of profit. So that begs the question. If the data is this obvious, why isn't Wall Street seeing it? Well, this is where our data-driven insight really clashes with the consensus view. You see, institutional models are built on certain assumptions, and right now, those assumptions might just be leading them to a totally wrong conclusion.
And here it is. This is the exact point of misinterpretation. On their last earnings call, management said they were tempering expectations on revenue because of a shortage of DDR5 chips. Wall Street heard lower revenue and immediately modeled a weaker quarter. But they totally missed the second part of that equation. With supply this tight, Corsair can sell every single unit they can make at a much, much higher price.
So here's the divergence, laid out plain and simple. The street is modeling a gross margin of around 27%, assuming things are just stable. But based on that inventory lag and the massive surge in component prices, our thesis points to a potential gross margin well over 30%. The implication there, we go from muted earnings to a significant earnings beat. It's a totally different picture. Okay, look, no setup is ever a guarantee. A true data-driven approach means being objective and always acknowledging the risks. So let's lay out both the bull and the bear scenarios to get a really balanced view of the whole situation. So the bull case is pretty straightforward. That margin expansion leads to a huge earnings surprise. You get strong holiday demand, maybe pushed by big games like Battlefield 6, and the stock re-rates to a higher multiple. The bear case, though, you have to consider that a wider market sell-off could just wash out any good news, or consumer demand for high-end PCs could just dry up. It's also possible the market just shrugs off the margin beat and the stock goes nowhere. These are very real risks to keep in mind. And that really brings us to the final question, doesn't it? Based on all the data, there's a really compelling argument that the market has fundamentally mispriced Corsair's short-term profitability. Now, if this thesis plays out, even a conservative re-rating could unlock some serious upside. The data suggests it's absolutely possible. But hey, the next earnings report is going to tell a whole story.
So that's our breakdown. And as always, remember to follow the data, not the noise. Stay disciplined and stay liquid. And please, just a reminder, this analysis is strictly for educational purposes. It is not investment advice. The data we've talked about is based on current information, and that can change in a heartbeat. It is absolutely essential that you do your own due diligence.
We are tracking these flows in real time. While you analyze the next move, go ahead and check out the tools in the description. You can sign up for Public and get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links are right down below. And hey, like and subscribe for more deep dive analysis.